NextEra Energy Partners currently offers a forward yield of over 10% with a buy rating from Wall Street. We also note it has been hammered down 44% over the last 12 months. So is this a buy right now with a very nice forward yield? As always, we will do a deep dive. We also want to understand why the dividend safety score does look to be borderline safe. We'll also touch upon why it has been hammered over the last 12 months and look to both insiders, where we note an insider buy, as well as the institutions, whether or not this is one they have been adding to the portfolio in the more recent period. And as always, we'll look at both top line revenue growth, bottom line net income, as well as a quick look at the health of the company, total cash versus total debt, whilst diving into the stock analysis, understanding the intrinsic value of NEP, the acceptable buy price given our investor margin of safety, and how much implied upside Wall Street are forecasting over the next 12 months. So let's take a quick look at the historical performance, and what we do note is it currently sits in the mid to lower end of the 52-week range, and it does have a forward P of just over 10. Now, over the last 12 months, it has been hammered, as we said, 44%. Interestingly, though, over the last few months, year to date, we do note it is up around 11%. And over the last 10 years, if you have been a shareholder, as we can see here, it was trading pretty much around the same price it is now around 10 years ago today. So let's take a look at this company. First, let's see how their top line has been increasing. We do want to see some nice growth, and what we notice, 359 million reported in revenue in 2014. Latest annual report, just over 1 billion. So we see around 3 times growth over the last 10 years. We also note increases pretty much consistently over the last 10 years as well, although we do note a drop into 2021 before recovering. When we take a look at the bottom line net income, what we can see, 31 million recorded in 2014 with 200 million in 2023. So a very rapid increase over the last 10 years. But when we look on the graphical basis, we do see a lot of inconsistencies year on year. So whilst the top line revenue has pretty much increased consistently, we don't get that same picture here from the bottom line net income. Now, in terms of looking at their health, the total cash versus total debt, 106 million in terms of the cash on the balance sheet in 2014, around 245 in their latest report. So we see more than double the amount of cash they had over the last 10 years, and we can also see over the longer term their cash position has been increasing as well. Now, in terms of their total debt, how does that compare? Well, they don't have a large amount sitting in 2014, 1.9 billion, although we do notice an increase around 3 times into that latest quarterly report of 6.3 billion. And as we can see here, a trend where the total debt has been increasing over the longer term. So it will be important to understand that dividend safety, as one of the reasons you may be interested in this company is due to the very high forward yield that we do see here. Now, in terms of some of the reasons why the company has been hammered over the last 12 months, we can see their dividend was looking to be cut, not in terms of an actual cut to the dividend, but the actual growth guidance forward looking, as we can see, is down around 50%, where typically their range of increases was 12 to 15% annually. They now only expect this to be 5 to 8%. Now, if you're a regular viewer, you already know 5 to 8% is still very solid, as we want a minimum 4% or more increase year on year just to keep up in line with inflation. And if they can execute on this while offering a nice yield of 10% plus, then this is still very, very strong. Another thing that we did notice over the last few months was they did trim their outlook forward looking, so their guidance also dropped. We can take a look at those numbers later on as well. Now, in terms of their earnings, how have they performed? What has their track record been? Over the last 4 quarters, their earnings per share, in fact, they did beat 3 of the 4 last times, so a 75% record, with the last 3 being beats. So that is positive. One thing we would say, though, forward looking, it does look fairly inconsistent. The next quarter, strong double-digit growth year on year, as well as the following quarter, although the next 2, as we see quarter 4 of 24, as well as quarter 1, double-digit negative growth, and quarter 1, 25, single-digit negative growth. And something just to point out, the earnings per share over the full year in 2024 is anticipated to be 332, with a forward yield of 1022. However, over 2025, the next year, we do notice it is anticipated to be lower, hence why the forward P does look in fact higher for 2025, something just to incorporate when we do take a look at the valuation. Now, a few things that we will cover. First one being the valuation. They do get an A+ grade. Now, when we take a look at that, understand why. The metric that we like to focus on, the P non-GAAP forward-looking, 10.22, with others in this sector around 16.47. So you are getting a nice discount of just under 38%, although that is based on if companies in the sector are of a similar projection moving forwards as NEP. There are other ways to value a company. Another one that we can take a look at is the price to cash flow here, 4.36. But again, it isn't one that is relatively relevant for the utility sector. But overall, they do get a valuation grade of an A+. You can see the other metrics if these are ones that you do want to incorporate into your own thesis. We then move on to the growth grade. Now, they do get an F in terms of year-on-year growth, 16.83%, a lot better than the negative growth of the sector median. When we take forward-looking, 7%, sector median around 3.19, so a very positive metric. However, when we do take a look at the earnings per share forward-looking, negative 79%, with the sector median at 6.37, so they do get a very poor F grade, and there are a few others here if you do want to take note, but overall in this certain category they do get an F. When we then move on to the profitability, they get an F overall. Some of the reasons why: well, firstly, gross profit margin that we always point out, 55%, better than the sector median, in fact by 23%. Bottom line net income also very strong, 26%. They get an A+, as we can see the sector a lot lower at 12.2. And then when we also look at the cash from operations, 727 million, some way away from the sector, around 1.28 billion. Overall though, as we can see, they do get an F. Other ones, if you do want to take a note, for example, the return on total assets, 1.27%, a lot lower than we can see others in the sector, 2.57, so it is worse off by around 50%. In conclusion, for this part of our analysis, a buy from Wall Street, a double hold seeking alpha and quant. In terms of the valuation, A+, however, both growth and profitability are an F, but again, it does depend on which metrics you do incorporate into your own investing analysis. So let's jump into how they performed against others in the sector. So we can have a look at the renewable electricity sector for utilities. We have Atlantica Sustainable, Enlight Renewable, Ormat Technology, and a few others here to show. So over the last year, including reinvesting those dividends, so total return, you would be down around negative 37%. They have been the worst performing. When we expand over the last 5 years, pretty much flat around negative 2.73, again one of the worst performing. If you expand over the last 10 years, so every single quarter you are reinvesting those dividends, they are in fact the second best, up 65%. Let's be honest though, that is a very poor return over a 10-year period, but as always, past performance is never an indicator for the future. Otherwise, we would all have the crystal ball and be able to predict the stocks to buy right now. In terms of insider ownership, 0.14%. We know one instant of insider buying, although that is within the last 3 years with no insider selling over the same period. We have around $100,000, and you do have to go as far back as to Q2 of 2023. Now, it is quite irrelevant as it is outdated, but for those that do want to see, it was the director on the 27th of April, so about a year ago, bought over 1,000 shares, as we can see, an average price significantly higher than the current trading price, and as we can see, for $100,000. Then when we take a look at some more relevant data, institutional ownership, 66%. We see 414 million worth of sales over the last 12 months, nearly double that over the same period, so that is a very positive sign. And in fact, over the last 4 quarters, as we can see, green more than red, institutions have been buying more quarter on quarter. So good sign, but as always, do your own due diligence and never copy what these guys do. Now, before we jump into this metric, just to let you know, we have released our latest free weekly article, 20 undervalued dividend stocks to consider for the portfolio. If you want access to this or any other article, all completely free, click on that pinned comment below. You can get instant access. And just to let you know, if you do want to know what websites and resources we use, we do explain all in this article. So in terms of the borderline safe, 42, market cap 3.17 billion, and we can see a forward yield of 10.55%. This is also a mid-cap company. Now, just a few weeks ago, it was reaffirmed that their dividend safety is a 42 score. What this effectively means is that there is a moderate risk of a dividend cut over the full economic cycle. So let's break that down with some of these metrics. Now, dividend growth, very strong. Just last year, double-digit 11%. Over the last 5 years, 14%. And as we just ran through earlier on, they have decided to cut that. Their guidance from the high 12 to 16% is now around 5 to 8, which is still very good for a company that does offer some very strong dividends. They have also been increasing those for 9 consecutive years. Now, in terms of dividend yield theory, it states the company is undervalued when the current yield sits above the 5-year average, so we have a massive undervaluation signal here. Forward P to DCF as well, 8.8 with the 5-year rolling of 17.9. We also note it is much lower than utilities, which does sit 11, and hence why we did get that A+ valuation rating earlier on as well. Just remember though, we don't look at any of these models in isolation, and we will conclude shortly. So in terms of the payout ratio, now for yield codes, we do look at this DCF payout, 90% or lower. This is essentially the distributable cash flow, very similar to free cash flows. Now, below 90%, pretty much been that over the last 10 years. The only thing we would point out, it has increased significantly, or the expectation is that it will, to around that 92% level, something just to be aware of, and probably why we do currently see that borderline safe score on the dividend. Now, in terms of the DCF per share, again, like free cash flow, like earnings per share, you do want consistent increases over the longer term. We do note pretty inconsistent over the last 3 years, pretty much flat, and I also want to point out over the next 12 months, it is expected to drop, as we can see, to around 386 per share. In terms of the growth then, if you just want to see it in percentage wise, in terms of sales though, as we did look at earlier, ideally we do want to see double digit growth. What we can see, they've achieved that over the last 2 years as well as the trailing 12 month, but as well we have seen 2 of the last 10 years with negative growth. Numerically speaking though, we can see, as we looked at earlier, they have pretty much tripled over the longer term. And one thing we do want to point out, with the shares outstanding, it has increased over the longer term, so they would have diluted your position. But again, this is very typical in this sector, something that we have noted when reviewing companies in the same utilities area. ROIC then, ideally we want to see 10% or more, just to give us faith management are able to effectively allocate their capital. For the utilities, 3 to 5%, but even over the last 3 years, it has been sitting at 0%, something just to factor in. And then when we take a look at the margin, it has been decreasing over the longer term, so there's a potential red flag indicator, something you definitely want to keep an eye on quarter to quarter as well as on an annual basis. And the free cash flow margin, again, not something that is meaningful for MLPs, so not something that we will take into consideration today. When we take a look at the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, reminder that these are the number of years it would take the company to pay off all of their debt net of cash on hand. We do want to see below 4.5, and this ultimately correlates to both dividend safety and balance sheet strength. It is quite positive, to be honest. It has been decreasing over the longer term. 3 expected in 2024, which is significantly lower than 4.5, and 3.24 looking healthy in 2023. So the only worry here is with that payout ratio, which does look like it is extending to around 90%. Otherwise, their debt levels do look okay. The balance sheet does look okay for now. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we are using, Graham's valuation, we have the EPS as well as the long-term growth rate and the AAA corporate bond yield to give an intrinsic value of just over $30, although we do see the market value around 33.87, so we have our first overvaluation signal. Just bear in mind that we're not looking at any one of these models in isolation. We then move on to the multiples valuation model. Companies in a similar sector and size that we analysed earlier, their average P multiplied by the EPS of NEP to get an intrinsic value showing some severe undervaluation, and we do get that undervaluation signal for the first time today. We then move on to the dividend model. Now, as we can see, the current dividend is around 3.6. Now, as we did take a look over the longer term, it has been increasing by around 14%, but management are now anticipating forward-looking 5 to 8%. We have gone extremely conservative at that 1% level, as there is a potential risk of a dividend cut, and with that 1% we do get another undervaluation signal coming to an intrinsic value of 51.51. Now, discounted cash flow model, as free cash flows aren't relevant for MLPs, it isn't one we are including in today's episode, so we're jumping straight into the intrinsic value. As we can see in today's episode, the average of these 3 models at $45.32. As always though, you can grab a copy of this model to get to both intrinsic value and acceptable buy price of companies in your own portfolio by clicking on the pinned comment below. We start off now a margin of safety. We execute on 10% if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for NEP, well, it would be a buy at around $41, and then we keep going to see what the MOS level is in today's episode, and we can see it is pretty much trading at a 25% margin of safety for a company that is yielding over 10%. In terms of Wall Street and their price target, well, as we can see over the next 12 months, they do believe upside of 21%, their price target $41, indicating this is a buy, as we did discuss at the beginning of the episode. As always, let us know your thoughts in the comments below. Is this high yielder one you are considering to add? Maybe it's on your watch list, or maybe for whatever reason it isn't one you are looking to consider in the portfolio. If you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop, and we'll see you all on the next one.